Welcome back to the Deep Dive. We're looking at some really interesting, almost contradictory signals in the market this week. Record highs at home, but driven by traditional sectors, while retail money is flooding into very different bets overseas.
That's right. It's a fascinating split. So today we're diving into the Seoul Economic Daily's reporting to make sense of these currents. We'll hit three key areas: the KOSPI finally cracking 4,100, what retail investors, the ants, are buying abroad, and a really important issue with domestic retirement funds.
Okay, let's start right here. Big day for the KOSPI. Even though the Nasdaq took a hit overnight, down over 1.5%.
Yeah, tech sell-off over there.
Exactly. But here, the KOSPI finished up 0.5% at 4107.50. That's the first time ever closing above 4,100. History made.
And what's really striking is what drove it. It wasn't the usual tech suspects this time. It was the old guard, the big manufacturers, specifically automakers.
The tariff news.
Precisely. The reports about a deal on Korean auto tariffs between the Korean president and former U.S. President Trump, that was the spark.
Right, that uncertainty had been hanging over auto stocks for ages, keeping them stuck. So when that news broke,
It was like a dam bursting. Hyundai Motor shot up, what was it, 9.43%? Kia climbed over 3%. Hyundai Glovis surged more than 10%. Big moves.
and that has implications for the big corporate rankings too, right?
Absolutely. Hyundai Motor Group is now breathing down LG Group's neck for the number 3 spot in market cap. They're only about 1 trillion apart now. Shows how fast politics can shift market value.
So who is doing the buying to push the index over 4,100?
It was clearly the institutions. They bought a net 815 billion won, roughly $600 million, just on that day. Really carried the market.
And foreigners. They'd been selling Hyundai.
They flipped. After selling for 7 straight days, they turned around and bought about 51 billion won worth of Hyundai. But it's interesting if you look at the whole month,
Okay.
institutions and foreigners were net buyers overall for the month, trillions of one each. But retail investors, the ants, they actually sold. Net sellers to the tune of 6.7 trillion won.
So taking profits while the big money moved in.
Seems like it. Cashing out on the rally.
And the analysts jumped right on this, upgrading Hyundai.
Immediately. NH Investment raised their target to 330,000 won, Samsung Securities to 340,000. They see the tariff uncertainty lifting as a major positive.
Is this just a short-term pop, or is there a longer view here?
Well, some analysts, like Cheng Ho Kim at Korea Investment and Securities, argue it's more structural. He pointed out Hyundai held market share even with the tariff risk. So a lower rate, maybe that potential 15%, could let them grab even more share.
Right.
He's projecting a new earnings growth cycle starting around 2026. So yeah, looking beyond just the immediate relief.
That's a strong case for the traditional sectors. And you mentioned it wasn't just autos benefiting from this improved U.S.-Korea cooperation vibe.
No, shipbuilding is also getting a boost. There's talk of a second rally there, partly linked to defense. Yeah, like the news about HD Hyundai Heavy Industries bidding on the design for the U.S. Navy's next-gen logistics ship. Those kinds of potential long-term defense contracts, they add a different dimension beyond just commercial shipbuilding.
Okay, so that's the picture domestically.
Yeah.
Institutional money flowing into established industries, pushing the index to records.
Yeah.
But you mentioned retail investors doing something very different. Let's pivot overseas.
Right. This is where the Seo Hakemi, or retail investors buying foreign stocks, literally the ants of the West, come in. And they made truly massive bets in October.
So big.
Record-breaking. Over 8.9 trillion won in net purchases of overseas stocks. That's about 6.25 billion US dollars in 1 month.
Wow, that's huge. Pushed total holdings to a new record, too.
Yeah, past 259 trillion won. And almost all of it, something like 94%, is in U.S. stocks.
Okay, nearly 9 trillion won in a month. Where did it go? What were they buying?
The focus was intense, mainly AI and, interestingly, quantum computing. The number 1 stock they bought was IonQ.
IonQ, the quantum computing firm. How much?
They poured in a $568 million USD net. And here's the kicker. IonQ stock had just tanked, like 24%.
So they saw that massive drop and bought the dip. Hard.
Exactly. A clear buy-the-dip strategy, viewing that sharp correction as an opportunity. Very risk-on.
Very aggressive. What was number 2? Let me guess. NVIDIA.
You got it, NVIDIA. About $415 million in net buys there. Of course, NVIDIA just became the first company ever to hit a $5 trillion market cap. The AI momentum is just incredible.
And number 3? More AI.
Sort of. It was IREN, used to be Iris Energy. They're a Bitcoin miner but have heavily pivoted into AI cloud services. So again, chasing that AI infrastructure angle, whether it's hardware, software, or pure compute power.
So even if we look beyond just October's buys at what they hold overall.
Still the big tech names. Tesla, Nvidia, Palantir are the top three holdings. The conviction is clearly still there, centered on AI and major tech players.
And analysts are feeding this. I saw a note mentioning some pretty high S&P targets.
Yeah, DS Investment and Securities is talking S&P 7,000, maybe even 8,000 next year, mostly driven by AI actually starting to show up in earnings. The risk appetite, certainly among analysts looking at the U.S., doesn't seem to be going away.
Okay, so we've got this real split.
Yeah.
KOSPI hitting records on autos and ships, retail investors making record bets on AI and quantum overseas. Which brings us to the third theme from the sources, something maybe less glamorous, but potentially more worrying long-term.
Definitely. It's about our domestic retirement savings, specifically the defined benefit or DB plans. That's where the company manages the pension pot to give employees a set payout later.
And the numbers there, not good.
They're pretty dismal, honestly. The average return on these DB plans over the last 5 years, just 2.7% per year.
2.7%. That barely keeps up with inflation, if at all.
Exactly. The assets are essentially treading water. And the core reason is that most of the money is just sitting in principal guaranteed products. Very, very conservative.
What's the danger there, besides low returns for retirees?
The risk shifts to the company. If the fund doesn't earn enough to meet the promised payouts, the company has to make up the difference. It becomes this hidden, growing cost on their books.
But weren't there rule changes? Mandating committees and investment policy statements, IPS, for bigger companies?
There were, starting in 2022. But the reports suggest they haven't really moved the needle. You know, having a committee or writing a plan doesn't automatically change how conservatively the money is managed day to day.
So what's the solution then? How do you fix that 2.7% return?
Experts point towards really embracing ALM,
ALM.
asset liability management. It means you don't just manage the assets in isolation. You have to actively manage them against the liabilities, the pension promises you've made. You need to match the investment strategy to the long-term nature of those retirement debts.
Okay, so thinking about the payouts you owe decades from now when you decide where to invest today.
Precisely. Look at Japan's DB system, for example. The sources highlight how they're much more diversified, regardless of fund size. They allocate significantly more to equities, foreign assets, even alternative investment.
Alternatives like real estate or infrastructure.
Exactly. Things beyond just stocks and bonds. And the key is they have a rigorous process. They plan the allocation based on ALM, set guidelines, track performance closely, and actually rebalance. It's disciplined.
The sources mention Seven & I Holdings in Japan as a case study.
Yeah, it's a great example of the diligence needed. They apparently only tweak their main portfolio weights every 3 years or so. But the discussion for the last change took 15 months.
15 months to decide on allocation changes.
Right. It shows it wasn't a quick market call. It was a deep strategic review based on their long-term liabilities. They ended up cutting back on foreign bonds and significantly increasing their allocation to those alternative assets we mentioned.
That kind of long-term liability-driven thinking seems key to getting out of that 2% rut.
It's really the only sustainable way. Otherwise, you have this structural drag, not just on retirement outcomes, but on the companies themselves who are stuck backstopping these low returns.
So to wrap up today's deep dive, we've seen the KOSPI braid 4100, powered by a resurgence in traditional auto and manufacturing stocks following key tariff news. Simultaneously, retail investors set records betting big overseas, particularly on futuristic tech like AI and quantum computing. And underpinning all this, a serious challenge remains in boosting the performance of domestic DB retirement funds away from that stagnant 2.7%.
We certainly hope breaking down these different threads provides some useful context as you navigate the markets.
We'll be back soon with more insights from the financial world. Thank you for joining us for the Deep Dive.
Just a reminder, this content is for informational purposes only. It's not investment advice. Any investment decisions are solely the responsibility of the individual investor. Estimated running time, 8 minutes, 5 seconds, approx. 1,340 words.